23% year to date and counting. My $100,000 portfolio built for my newborn son is now at $122,784, nearly doubling the S&P 500's 13% gain. But here's the twist. My market monitor just flashed day 11 of a typical day 12 to 13 cycle. That means we might be 1 or 2 sessions away from a pullback. So today, I'll show you exactly how we got here, sleeve by sleeve and trade by trade, and why I'm quietly tightening risk even as the headlines scream new highs. This isn't a YOLO growth account. It's a legacy portfolio for my kid designed to prove that you can beat the index with discipline, low volatility, diversification, and no new deposits. Think of it as a modern 60-40 portfolio with a twist, roughly 60% equities and growth and 40% bonds and income, plus carefully chosen options to hedge the account, generate cash flow, and also generate some growth. The mission is simple: steady compounding, minimal drawdowns, and real freedom. And the numbers, up 23% year to date, speak for themselves. So this update is recorded Thursday evening ahead of Friday's open. The S&P 500 is up about 1.8% this week, and we're up about 4% this week. But my proprietary market monitor, my market filter, is green at the moment, but it's getting late. So it suggests that we're about to turn towards a yellow cycle. So translation, I'm still buying selectively, but I'm shifting towards longer term positions and tighter stops in the case the market starts to cool. Here's the 30,000 foot view of the 100K account allocation. So we have 34% in US small caps, 26% in international equities, 20% in fixed income, 10% in options and hedges, 6% in large cap tech, and 2% in Bitcoin covered call funds. Every sleeve is a deliberate puzzle piece to smooth returns while leaving room to pounce when opportunity knocks. So small caps are the engine of growth for the account. We have gold miners, AI chips, auto parts, biotech, energy drinks, makeup, solar, nuclear, and even some crypto. It's breadth by design, dozens of themes so no single story can derail the performance. International diversification. We have Asia, Latin America, a slice of Europe, Chinese internet, Brazilian fintech, and Canadian miners, and some Israeli shipping. These often zig when the US mega caps zag, giving me low correlation upside. So fixed income is my contrarian core, so long-term bonds and niche income plays everyone else calls dead money. Corporate bonds, treasuries, preferreds, baby bonds, CLO funds are steady cash flow today and the price pop potential when yields finally break lower. So options and hedges, so long dated leaps across tech, biotech, VIX calls, QQQ put spreads for insurance, and these are my sleep at night trades, allowing aggression in equities without losing sleep over it. And large cap tech and cash, so just a modest Tesla and Amazon sleeve, around 6% of the portfolio combined. Cash includes a Bitcoin covered call ETF for a touch of crypto yield. And so that's the blueprint, but where did this week's real fireworks come from? Let's light up the heat map. So bigger blocks mean bigger positions, and the standouts this week are Tesla is our largest position, ripping on a textbook breakout that I'll get into later. Warner Brothers Discovery spiked on buyout chatter. PagSeguro, Inod, Digital Turbine, BMNR, and Zim all logged double-digit moves, some up 20% in just a few sessions. And fixed income cooled off, exactly what I expect from a balanced portfolio after last week's big run. So the Tesla chart in particular is a masterclass in accumulation. So let's zoom in. So here's the Tesla chart. As you can see here, there's 7 down waves inside of a long base, each weaker than the last. The on-balance volume stayed above its yearly moving average the whole time, a classic Wyckoff accumulation. So when it finally broke out, it was off to the races. Notice the higher lows. Notice the weakening of the downward advance throughout the sideways motion. The next stock is Warner Brothers Discovery, buyout rumors lit this monster gap up. Unfortunately, I sold the $14 calls to reduce volatility, so the profit was capped at 14. But that's the price we got to pay for consistency, and sometimes you miss a moonshot, especially in this market. BMNR is one of my favorite compounders. We loaded up around $40. It's nearing $60 for a 50% gain, and I still see multi-bagger potential in this name. So these lessons aren't just for show. They're the playbook for spotting the next breakout. We always want to watch the stocks that performed really well during the week and then see how they moved. Like, what did they look like before? And then what did they look like after? So this week, I opened up 2 fresh options positions, one in TDOC. This stock has been in a long downtrend and it's finally basing out. Sideways action with rising volume and lower volatility, signs of accumulation. So I bought some long leaps and sold the shorter $10 October calls for some income. And the other stock I bought is Jack in the Box, ticker symbol JACK. This thing is very similar to TDOC. It's a brutal 80% decline from $100 to $20. Big volume spikes at the lows, hinting at some accumulation going on. And restaurants as a sector are really beaten down. If sentiment turns, this is a high beta rebound candidate. So, hey, if you guys, I'm curious what you guys think. Which one do you think will move first, TDOC or Jack? Or if you think they're both terrible picks, let me know in the comments. I'm still running the QQQ put spread. They're slightly underwater, but it's cheap insurance in this market given the VIX is so low. So my market monitor suggests we're near the end of an average green phase. So if history rhymes, we drift sideways into early October and late September, and then enter a distribution phase, maybe halfway through October, exactly when the hedges are going to start paying off. This week reinforces why diversification with conviction works. Small caps drove gains, fixed income cooled but stabilized returns. Options and hedges let me stay aggressive without losing sleep. And remember, this is a legacy account for my kid. Steady compounding beats adrenaline every day. So in closing, the portfolio stands at 122,784, up about 23% year to date, comfortably ahead of the S&P 500. I share every sleeve, every trade to prove that rule-based investing can outperform without daily stress. If this transparent breakdown gives you guys ideas, hey, tap that like button so other investors can find out and you guys can help out the channel. And tell me in the comments which sleeve, small caps, bonds, or international, would you overweight right now? I read every reply and feature the best ideas on my next week's videos. So don't miss any Monday video where I'll break down the weekly market signals and show the early tells for the next green cycle. We go over every market, every index from the S&P 500, QQQ, gold, and Bitcoin. So until then, stay disciplined and keep compounding. Thanks again. I'll see you guys later.